Money feels solid. You work for it, you save it, you worry about it. But the system that creates and moves money is surprisingly fragile and strangely invisible. Most people imagine money flowing like water, earned, stored, lent out carefully. That's not what's happening. Right now, as you're watching this, money is being created out of nothing, quietly, legally, constantly. And almost no one explains how. Not because it's secret, but because once you see it clearly, you can't unsee it. Here's the uncomfortable truth. The financial system you live inside was never designed to feel fair, stable, or intuitive. It was designed to function, even if it feels absurd. And today, that system matters more than ever. Because inflation isn't just prices going up. Debt isn't just money you owe. And banks aren't just places that store cash. There's something else entirely. To understand this, we need to rewind. For most of history, money was physical, scarce, heavy. Gold,
Whoa,
silver,
it's finally starting up!
coins you could
Look at
drop
those
on the
gears
table.
go!
If you wanted to lend money, you had to actually have it. Then banks noticed something. Most people don't withdraw all their money at once. They leave it sitting there. So banks started lending part of it out. Then a little more. Then a lot more. This became the foundation of modern banking, fractional reserve banking. Here's the simple version.
The deal
You
is
deposit
done, and justice is
$1,000.
served.
The
A
bank
perfect
doesn't lock
balance,
it in a vault.
indeed.
It keeps a small fraction and lends the rest. That loan becomes someone else's deposit, which gets lent again and again. One deposit quietly multiplies into many claims on the same money. No trucks printing cash, no vaults filling up, just numbers added to screens. This is how most money is created today, not by governments, by banks. When a bank issues a loan, it doesn't give you existing money, it creates new money. Your debt becomes someone else's asset. This is legal, normal, and central to the system. Now here's where it gets uncomfortable. Almost all money in the economy exists because someone owes it. If debt stopped growing tomorrow, the system would freeze. That's not a metaphor, that's math. But we're taught a different story. We're told banks are intermediaries, middlemen, connecting savers and borrowers. In reality, they're manufacturers. They manufacture money by manufacturing debt. And once you see that, inflation starts to make more sense. Because inflation isn't just about supply chains or greedy companies, it's about dilution. When new money is created faster than real goods and services, the value of existing money quietly erodes.
Let's see
No
how these
alarm
numbers come
sounds,
together for
no
your loan.
announcement is made.
They combine to
You
create
just
flexible
notice that
options
your
just for
grocery
you.
bill feels heavier. Now, zoom out. Who controls this system? Central banks.
Whoa! What's
They
happening?
don't print
The
money
gears are turning,
directly
and the
most
smoke,
of the time.
it's everywhere.
They
This is
influence how
insane.
much banks can create by setting interest rates, by buying financial assets, by signaling confidence or fear. Interest rates are the steering wheel of the economy. Lower them and borrowing explodes. Raise them and debt starts to crack. Every financial crisis you remember follows this rhythm. Cheap money, excess borrowing, asset bubbles, then tightening, then something breaks. In 2008, it was housing. In 2020, it was everything at once. Each time, the response is the same. More money, more liquidity, more intervention. The system survives by expanding. And this is where the irony lives. We're told money is about discipline, saving, responsibility, hard choices. But the system itself survives by doing the opposite, by borrowing from the future, again and again. Governments run deficits, corporations roll debt forward, households juggle payments, and as long as confidence holds, it works. Confidence is the real currency. Because money today isn't backed by gold, it's backed by belief. Belief that debts will be paid, that institutions will hold, that tomorrow will look enough like today. When that belief cracks, things move fast. Banks don't fail slowly, they fail in weekends. Currencies don't collapse gradually, they snap. Now contrast this with how the system is sold to the public. We're shown charts of growth, talk of stability, smooth narratives. But behind the scenes, it's more like constant improvisation. Central banks reacting, markets testing limits, policies adjusted in real time. There's no master plan, just risk management. And this is where the real stakes appear. Because the system rewards proximity. The closer you are to new money creation, the more you benefit. Banks, large asset holders, governments. By the time new money reaches wages and savings, prices have already adjusted. This isn't a conspiracy, it's a structural effect, like standing closer to the fire. Now zoom out even further. The global financial system is tightly interconnected. Debt in one country is someone else's asset somewhere else. Currencies compete. Capital moves instantly. A rate hike in one country can destabilize another. We've built a machine that demands constant growth in a finite world.